So the question was asked recently, what is a victory spread? How does one go about setting it up? And a victory spread, to really understand what a victory spread is, you have to understand what a ratio spread is. And we're going to talk about that first, and then we'll go into a victory spread. So what we're going to start with is what we call ratio spread. And the idea here is that we're going to sell a call and buy two or more call options. And ideally what we're going to do is we're going to sell a call for enough money that it'll pay for the other two options. And to do that, we're going to probably start, we're going to look at Green Mountain Coffee as our example underlying stock. And this call ratio spread is going to be a bullish trade, but it's going to be a limited risk trade. And the hallmark of the spread is that we're going to have unlimited upside potential. We might even have some limited downside profit potential. And then we're going to have an area where we could potentially lose money on the trade. So the way we set this up is first we have to select an option that we want to sell. And for this, we'll start selling the at the money 82.50 call option. That's going to bring in $5.45, which means that we can spend about $2.50 on our options, on our call options. So we're going to buy two options at the 92.50 strike. So these are going to cost us about $4. We've got $5.45. You can see down here that we've got a positive cash flow of $1.36. And we're going to have a slightly negative delta, but we'll talk about that a little bit more as time goes on. And we're going to have a positive vega in the trade. So let's take a look at this. And here's what the trade looks like. And let's move it over a little bit here. So this is where the trade starts, okay? And if Green Mountain trades lower, right, we're going to do just fine. We'll have a positive theta. I'm going to click on the T0 line here. We're going to have a positive theta down as we start trading lower. And what's happening here is the spread's losing value, and that's going to allow us to eventually close it for a profit of a maximum of about $140. Okay, but what we're really thinking is that this trade's going to be a bullish trade, and so this T0 line reflects the value of the options today. This solid line is the expiration line, and that reflects the value of the options at expiration. So if we get a very prompt move higher in Green Mountain, we're going to trace along this dotted line here, and we have the ability to earn an unlimited upside reward. Now, we have to have a little bit of a reality check here because this purple line represents a 1 standard deviation move. So if we get a 1 standard deviation move between now and the expiration, we're looking at probably finishing right around here. What we need is a move that's pretty prompt and deliberate on the part of Green Mountain. Having said that, let's take a look at the expiration line. We've got break-evens here at 83.85 and here at 101.18. This area between the break-evens is what some traders might euphemistically refer to as the sea of death. This is where we lose money. To the left of it, we're going to make money, and to the right of it, we're going to make money. But that's the sea of death. So the thing we don't want to see happen is we don't want to see it make an initial move and then kind of linger in this area, because as time goes on, we start sinking lower and lower and lower in this proverbial sea of death. And so one of the things you want to do is, if you do find yourself stalled out in here and it starts sinking lower, you want to get out of the trade. So you want to limit your loss. So that's basically what we call a call back ratio spread. So what is a victory spread? Well, a victory spread is essentially a hybrid between the call ratio back spread and a diagonal spread. All right, and so here we have options all in the same expiration month. But what we're going to do to create a victory spread is we're going to still sell an option in an earlier month, in this October. So we're bringing in $5.45 here. But we're going to buy our options in November. Okay, so we're going to use a later month. And what we're going to try to do here is, let's see, if we maybe buy 3 options here in November at the 105 strike, we still have a slight positive cash flow. So we're bringing in $66 here, right? And then we're still selling our option here for $5.45. So we're going to make a little bit of cash, generate a little cash on the initial opening of the trade. And the trade looks a little bit like this. Now this expiration line, that date is hinged on the short option, or the option we sold in the front month. All right. So what we end up with is a trade where we've got a similar scenario where this, if Green Mountain reverses on us, we've got the ability to make a little bit of money. We've got a limited profit potential to the downside. And then what we're really looking for is a move faster to the upside. Okay? And we've got the same kind of sea of death scenario here, where if the move does not materialize as rapidly as we would like, we can find ourselves eventually in trouble here. Okay? So I'm going to add a couple lines here to kind of highlight how over time, so that this is 2 weeks into the trade, we might be down a few $100s. Then around about 3 weeks into the trade, we could be down a few $100s more, and then this is expiration down here. Now there's a couple characteristics about this trade to be aware of. You're going to have a positive vega throughout the trade. What that means is that if the market starts moving higher and you see a significant decrease in volatility, such as a 5% decrease, you're going to see it's going to hurt the trade. Okay, and the reason it's hurting the trade is because you've got those back month options that are those long options, and that time value is going to be depleted. Now, can you do this on the put side? And the answer is yes. So let's take a look at doing it on the put side. We'll sell the at the money option. We've got $5.90 to work with. And so then we'll look for November options that we can purchase, and we'll buy the 60s. Again, we've got a small credit here. We'll go and take a look at this, and you can see that we've got a similar graph here. Maybe not as favorable as we would like, and part of the reason for this is because when we look at volatility skews, these options are going to be a little bit more expensive. For example, if you remember in November, we were a little bit closer, and we were buying an options at $1.57. Here we have to move a little bit further out as far as the standard deviation is concerned. Okay, you can see the implied volatility here is quite a bit higher than it is up here, and that's pretty normal. So the volatility on these victory spreads does play a role. So you have to look at the implied volatilities and see if that works for you. It may or may not. An alternative would be to go with the put back ratio spread, where here we're selling the one for 590, and then maybe we come out here and buy 2, and then we've got a put ratio back spread. I hope that helps a little bit. If you would like more information, please feel free to join us over at TheOptionClub.com.